All right, what's up, everybody? Welcome to the Friday Mastermind. I was going to say it's the first Friday of 2025, but it's not. It's the second Friday of 2025. And today we have as our special guest, we have Mr. Dan Rawitch. We don't get Dan enough, but before I bring Dan on stage, what's up, Deborah Bird?
Good morning. We're having a little bit of a snowstorm here in Dallas, but I feel like I can't complain with the things that are going on in Southern California. So for any of you who are tuning in and you're away from your home, prayers to you guys. Please reach out and let us know what things you need. And, just my hearts go out to you guys.
Yeah, yeah. Big prayers to everyone being impacted by the LA fires and all the first responders and people that are helping them. I mean, it is quite the national disaster. So prayers to you guys. Mr. Bookspan, what's up, my brother?
Just squeaking in by the skin of my teeth. Had a great run this morning, and I was just feeling really good, and I just could not miss this conversation with Dan Rawitch on what's going to happen in 2025. I always joke my crystal ball's a little foggy, and so I like to quote his crystal ball instead of my own. So, yes, my sympathies as well, and certainly prayers out to the folks in California. My daughter isn't a safe area. She's, a little bit inland by the 405 and the 10, but my wife is out there and just says it's super scary. So definitely my thoughts and prayers out to all you out there, family out there.
All right, guys. So one thing I would love to do, we're not going to ask Dan to give us his, interest rate prediction for the year right off the bat, although at some point in this conversation, he will, like he always does, tell us like, hey, this is what I could see happening in Q1, Q2. But I would love for anyone listening to this, if you have a projection as to what will be the lowest interest rates get this year, put that rate in. Like if you think, hey, 5.5, we're going to see 5.5 in 25, put that number in. If you think it's going to stay in the sixes, put that number in. I would just love to have a couple predictions from the audience. So we've got one prediction at 5.875 being the lowest interest rates will be in 25. Would love more predictions, guys. But with that said, we're going to bring on the man who has been the chief economist for Mortgage Coach and Trust Engine for, God, I mean, it's more than a decade now, Dan, right? Like, I mean, how many years has it been? You're on mute, by the way.
Sorry about that. Yeah, we started in '08.
Oh
Um,
my gosh.
yeah, I still remember. It's kind of crazy how some moments in your life you remember, and you're like, this one's obvious why I would have remembered it because it's been a crazy, like crazy great experience. But I remember we were in our motorhome, and '08, everything was melting down, and we had just decided as a family, let's just go hang out in Mexico. Let this whole thing get better. And that's when you told me what you were doing and asked me if I'd be interested. But I literally remember the stoplight I was sitting at when we had that conversation. So yeah, it was '08, 16 years ago.
Yeah, and by the way, guys, that was a very dark time in the industry, and leadership was scarce. That was the same time I started doing the YouTube interviews because no one's doing weekly
No.
sales meetings, and was looking for ways to bring more leadership to the industry. And Dan, thank you for just so many years of value. For anyone who's new to this community, Dan does an update just about every single morning in our Rate Watch app. If you have not downloaded the Rate Watch app, just go to the Google store or any app store and type in Rate Watch. Typically, it's one of the top 20 mortgage apps, period. Like if you type in mortgage in an app store, both of our apps are usually in the top 20. But Rate Watch, guys, it's incredible. There's a morning update in that app every morning from Dan. He also updates our Facebook group. So, Mr. Dan Rawitch, take it away, brother. What do we need to know? Like, what's the signal? Like, what are the things that mortgage advisors need to know right now?
So let's pull up some slides here. I do tend to go through these pretty quickly, and just to remind you that they're yours. Just let us know afterwards, and we'll get them to you. So for me, I more think of this more of a macro overview, and then if you see a slide you really want me to drill down on, we can. But let's get through this first, because I think I'm not saying don't ask questions, but I think most of your questions will get answered by what I'm doing. So, and Dave, thanks for having me. It's been an incredible experience. So, love working with y'all.
Yeah.
I said y'all just for Deborah.
Yeah. No, it's mutual.
Oh, yeah.
Thank you for that,
So
Dan. Thank you.
you're welcome. So Dave sent me this yesterday and asked me if I would scan it. Um, and it's a pretty interesting discussion, right? What if? And actually, that's not even all that bad. I know how painful it's been. I don't discount that. I'm going to show you slides to reaffirm that pain. But I'm sure you guys are keeping up. The amount of people that are leaving this industry is unbelievable. Like, just what was that recent stat? Like almost half didn't renew their NMLS. It's just a crazy
Yeah,
number.
no, it's a astounding number of loan officers that have exited, and you know, I think most of the people I know, when we look at the market, whatever it was in the peak a few years ago, it'll be 50% as it settles out. Also, I think you were referencing when you said the article, it was from Ron Stowers, where he's like, "What if rates are as good as they're going to get?" Is that what you were referring to?
Oh, you can't see my slide?
No, oh no, were you showing it? Yeah, no,
Yeah,
we're not seeing your slide.
apparently not. All right, sorry. Well, that was big. That was
So
important.
by the way, guys, I'm going to put a link because I'm pretty sure he's referring to an article that I had forwarded him by Ron Stowers, who I have interviewed on this channel. Recommend you follow Ron. He's a great leader. Posts something pretty smart on social media every single day of the week. So truly a value. Deborah, are you following Ron on
Yes,
social?
LinkedIn.
Yeah, LinkedIn.
Hmm.
Cool.
I've started to go to LinkedIn a little bit more often, LinkedIn and X, more than my usual. So, yes.
Yeah. Okay, we see it, and I'm going to put a link to the article that we're referencing. But go ahead.
Okay, so yeah, this is really the question of the day. I think it's part of the reason why I'm here. Um, so let's start with a really broad answer, and that would be what would have to happen to change the current reality? So if nothing changes, inflation stays where it's at, GDP stays where it's at, unemployment stays where it's at, is the Fed going to lower rates? Of course not. The Fed will usually not lower rates until it's too late and the economy is already slipping like crazy. And jobs are always the last thing to go. So unemployment will kick up long after the other indicators that I'm going to show you. So our interest rates as low as they will be, it depends on inflation, jobs, consumer spending. Those are what drive rates. Um, there's been a long-term fallacy, at least in my opinion, it's a fallacy that a growing economy that's, jobs, all that stuff doing well equals inflation. And it doesn't. It never has. So there's so many things that people think that will create inflation. This inflation came from one thing, and it's the law of economics. I think Milton Friedman said that inflation is too much money chasing too few goods. So let's think about what happened with the government. Um, we had no goods to be chased. Every single thing was shut down. There was no production. And then we stuffed their pockets full of money. So now you got too much money chasing too few goods. And the most extreme examples on both sides that I've ever seen, we'll probably see in my lifetime. Too much money, just keep stuff in their pockets. Too few goods, everything that produces was shut down. So that's where inflation came from. And I know Powell took a lot of heat for it, but when he said inflation is transient, it is. It always has been. Find me a time, go back 200 years, where inflation has not been transient. The question is, how long does it hang out, at these various levels? And I think that Powell believed and led us to believe, I believed that it was more transient than it was. I expected things to turn faster. So this is not my prediction. I've got a couple of slides that are kind of consensus slides. So Fannie, MBA, Wells Fargo, you can see that where they think things are going to come out. So all of you that kind of are thinking low sixes, high fives, I would say the agencies agree with you. but I would also tell you they've never gotten it right that I can recall. I mean, right, really right. And then the trend down will continue into 2026. So I think generally, the pace of this might be okay, but when we see rates just boom shift like we have in many times, in our careers, it's usually because of a black swan event. So let's talk about a black swan event. Let's say that Los Angeles began burning like crazy, and thousands of people lost their homes, and businesses were shut down. And by the way, before all this happens, insurance companies cut thousands of people's insurance. Just my wife was telling me that James Wood, she just saw an interview for him, the actor, and he was literally bawling because the insurance company cut his insurance last month, and now he's lost everything. So what happens? I mean, people are out of homes, insurance isn't kicking up, lenders end up, holding the bag. You could literally start seeing defaults and foreclosures. I'm not saying that's going to happen, but I'm kind of giving you the landscape of what can create a black swan event, and this can. It just can. I hope it doesn't, but it can. And when that happens, that's when you see rates fall. The last time I was with you guys, I showed a number of slides that, like, once rates started falling over the next 6 months, it's every time it's happened. Once they start down, they fall so hard. This time's a little bit different. Once again, I have egg on my face. Twice I've come to you guys and spoken, the last two times, and I gave fairly, confident timelines of when I believed that rates would hit in the fives. And actually, they did kind of fleetingly go into the fives. And each time when I came on, rates were kind of doing what I said they were going to do. In some cases, they continued down a little while, and then they whip back the other way. So, I sit here feeling wrong and surprised that they're still as high as they are. But I don't like being one of these prognosticators that pretend like he didn't say what he said. I did say it, and a lot of you know I said it. So, but that doesn't mean it's not going to happen. Wall Street has that joke that even a broken clock is right twice a day. So
So
noon's
by the way, time out. So you stand by that you do think we, whatever the lowest estimates are, we could see lower rates sooner rather than later, despite all these predictions and forecasts. Like Dan is still sees a path to rates in the fives sooner rather than later.
That's what I think. And
Okay.
rather than just have opinions, because those are cheap, I try to back it up with data. And so for me, it's always been a debate that I'd love to have is like, Dan, you're a knucklehead. How can you say that? That's not a conversation I want to have. I don't mind the knucklehead part, but Dan, you're a knucklehead. You've shown me nothing to back up your opinion. And then they'll throw me their opinion and I'll say, back it up. And they can't. So you just have to always remember if you're talking about opinions or facts, and pretty much most of the stuff is opinions. So yes, I'm still extremely bullish on interest rates, and I'll show you some reasons why here as we go. Um, so this is a model that I've used over the years, and it's pretty darn good. And many of the things that I watch, they do have a forecast component. You do put some assumptions in here, but I've always used kind of the same assumptions, and this has always been pretty accurate. This is not my info. This is an AI model based on the algorithm that was created over all of these past interest rate moves. It does take into consideration jobs and some other things I'm going to show you. It does take into consideration inflation numbers. So, this is pretty much what I've been saying is going to happen. And we keep getting close, and then something will happen. The something this time is Powell. He wasn't our friend at all. I mean, he's gone from being a friend of ours to an enemy. I mean, he said that he sees the cuts moderating. So why would rates continue to go down when our Fed says that he thinks that that the reductions are going to moderate. The investors took him seriously. So yes, this could happen. And this is 2025, 2026, and it's pretty soon. So one of the issues that we've had with high rates and why I think I've been, I've been off, but historically, you're going to see the spread between 30-year mortgage rates, that's the blue line, and 10-year, you're going to see it at about 1.5%. To be very specific, it's ranged between 1 and 2% for decades. So that spread is a known thing. And that spread is currently like 2.5%. So even on the highest possible side of where these spreads have been historically, I'm not saying it's never gone over 2. I'm just saying 2 is considered a very high median or mean, and we're above that by 0.5%. Just normalize this for me, and I'm already pretty close to my goal, right? You could easily take 100 basis points off the spread, and all of a sudden, fixed rate loans are in the 5s. So this is hard. For me, it's harder to forecast this than it is rates, because rates, there's charts, there's technical things that I lean on that get me where I want to get. But the spread, I don't know. And the spread could skyrocket if this kind of LA black swan event started coming to play. The Fed would have to pump this down so fast because this end, these guys are going to want more yield when they're starting to think all my assets are on fire. This is not a good situation. So Wall Street will say, you know what? Here's the argument always. Am I better off getting a 4.5 almost? Absolutely guaranteed by the good faith of Uncle Sam, never defaulted, probably never will. Well, I don't know about that, maybe. So this, sorry, this is just lost my train of thought. Spread. Sorry, we'll keep going. So I think that so the decision is here's this. I can get paid 4.25, 4.5. Don't have to worry about anything. How much more do I need to get paid to take this extra risk up here? And so this is always going to be the perception of Wall Street that in terms of how much risk is in mortgages. And currently the risk is pretty low. I mean, based on defaults and all that stuff we've been seeing, but the spreads haven't narrowed. So I don't know what it's going to take, but they will narrow. And you can see just as of late, going in the wrong direction. The fixed rates got higher and the 10-year yield went down just a little bit. So that's something to watch. That could be a good kicker in our favor. I don't think it's going to get a whole lot worse. I think there's a lot more probability that it gets better before it gets worse. And this is just kind of interesting, and it goes in line with one of the questions you showed me, Dave, and that is where are existing mortgages, which are, which are in the 4% range on average, and then the new mortgages are now all the way up in here, and so there's a total here. But so the question is, if the average rate is 4.2% on a current fixed rate mortgage, that's far lower than the prevailing rate to a new home. 84% of homeowners have a rate 6% or below. And rates aren't expected to dip below that threshold anytime in the next few years. I don't agree with this, but what this is telling you is we're going to have to get things down. Personally, I think mid 5s, low 5s, and the industry explodes in a good way. I feel pretty comfortable that happens, because if the average rate is 4.2 and you get me down to 5.5, I am not going to sit in a home that I'm tired of or make my kids share a room if I don't have to, for the difference between a 4.25 rate and a 5%. I'm not. But the difference between 4.25 and 7 something, I am. Yet the numbers for housing are unbelievable. And we'll see some more of that.
Hey, real quick, go back to that, Dan. Uh, but we have this thesis that there are millions of people that are eligible to move up. They could move up. They want to move up. I don't have the data on what are the number of people that want to move up. I don't know if you have heard any data signals on that, or Deborah or Todd, but but when I do interviews with loan officers all the time, it's coming up where they're using MortgageCoach to say, hey, you're at 4. This is what a high 6 looks like. And then they're showing the appreciation rate, and they are helping people get clarity and confidence to move up and leave that sub 4% rate for that 6 or 7. What are your thoughts on that, Dan? And by the way, I see that as a really big opportunity to differentiate yourself and bring value, is to be that loan officer that can navigate that conversation.
Yes, because it's an age-old argument. We just went through it ourselves. We just bought a house. And I think for me and for my age and all that stuff, it's probably like more than we need. But we started thinking about it. It is our dream house. It's 2 miles away from my kids and grandkids, and the replacement cost of this home is 3 times what we paid for it, just because construction costs and land costs and all that have gone up. And so, did I love getting? I think we ended up at 6.25, maybe 6.5. No, there's a lot. The payment's more than I, typically would have been comfortable with. But then we started looking, and what this house could be worth in 2 years, you would just kick yourself for not taking the higher rate. And so that's how we ended up in the house. We said, what's going to happen if we wait? Prices are not going to go down. What would take prices down is if rates went way up. I don't think that's going to happen. So,
Todd or Deb, yeah, Todd, what are your thoughts?
I got a couple of thoughts, right, Dave? So you asked, how many people are pent up, and you know what? It's going to vary database to database. But I did about 50 annual mortgage reviews last summer. I used my exactly what to say question, because what I found is that I had people like thanking me, hey Todd, during COVID you got me 2.99. It's the best rate ever. I'm never going to move. And then I would say something like, well, could it be possible that since your kids left and you feel house hostage, you might that might change? And like, oh heck yeah, if rates got in the 5s, I would move in a heartbeat. So
there you go.
Clients are schizophrenic, right? And the challenge is that we don't dig deep enough. We're not curious enough. We don't ask enough questions. And so, I think it's all of this is a perfect setup, and maybe I'll just use it as my close, Dave. I'm really talking about the conversations you should be having now with your clients so that you actually know what your database is actually going to be doing. Because I think, I'm not making eye contact with any of you, but I think most of you don't actually know. You think right? We think we know what our clients are doing, but the bottom line is that you've had surface level conversations. You're not asking the right questions with the right amount of curiosity to truly get to where they want to go. Because what Dan did is what we know everyone should do. We all know we're smarter than our clients. We know real estate, we know mortgage, and we know you should be buying now when there's inventory, and then you should refinance later. But our average client doesn't think that way, but you think they should, and you're having troubles convincing them because you're just not letting them get to that conclusion themselves. So I will, Deborah and I can do a little bit of role play chat towards the end if there's time. If not, we can do it on a future call. But the bottom line is, be more curious with your clients and start making calls. So, whether the national statistics say that's 1% or 11% or 31%, it doesn't really matter. It matters what's in your database. And if you don't know, that's your problem.
Yeah. And we will try to save some time at the end. And so Todd and Deb, if you could get ready to do some role playing with Colin, because it came up in one of my other interviews where, loan officers have, at least most of them, understand that when it comes to optimizing rate and term refis, you want to have a strike price. You want to have that target rate that you've got alignment with the client. That's, I think, well understood. And what Todd said is you want to have a strike rate for move-up buyers. You want to have a strike rate for move down. You want to have a strike rate like, oh, I want to buy an investment house. Oh, I want to help my kids get into homeownership and house hack through college. Like whatever the real estate needs are of that consumer, you should have the next transaction, if not scheduled by the date, scheduled by the criteria that needs to happen. in order for them to want your service. And if you don't know that, you're just not optimizing your opportunity. So, all right, Dan, sorry to sidetrack you there, bro.
Yeah, no problem. So that's a pretty easy calc, right? And hopefully you're using some sort of CRM. You should just be able to give me all my rates, 4 3/8 and above, because when rates hit
Well,
mid fives, they're all going to be, ready to do something.
and reminder everybody, if you have the Trust Engine mobile app, like we will literally tell you, oh, this person's ready for a move up, this person's ready for a move down, and give you the script. The day that they become eligible and hit a certain propensity score, we'll tell you who that is based off data, and then we'll even give you a script. I want to show that at some point, Dan, but keep going, bro.
That's cool. Okay. So this is just more on the short-term side. Usually I do this closer to the end, but I know sometimes we end up going over time because I talk too much, and this gets missed and people get disappointed. So this is a chart. This is a weekly chart. That means that every one of these candles is a week's worth of price data. And the reason I did the weekly instead of the daily is I wanted to go way far back to really show you sort of what's going on. And what you can see here is we'll call this November of 23. So somewhere in that area, we hit a low at that point of like 3.8. And that was after getting knocked down. Whoopsie. Knocked down all the way from up here. So that was a good thing. This is yield, by the way. This isn't price. So lower is better. So we just began free falling and got to a pretty good level. But then we hit this yellow line. These lines are what's called Fibonacci lines. And I don't know that I have time to talk about it, but Fibonacci is a very magical thing. The numbers they're considered the golden sequence. Fibonacci are numbers that show up everywhere, everywhere. The number of petals on a rose, thorns on the stem, branches on the tree, how deep the root goes, how close is our nose from the middle of our eyes. Those are all Fibonacci numbers. And those numbers are repeated in DNA over and over and over and over. So some really smart guy, I don't know, 100 years ago decided, let's take Fibonacci numbers and apply them to trading. And it's just crazy. When you learn how to draw Fibonacci, you know exactly where things are going to go for the most part. So as it came down here, we got this bounce at 3.9, which was below 4. And it was kind of a bummer because we really wanted to get further below 4 and stay there. But it bounced from this Fibonacci level and then it hit almost exactly where we are right now. So call this 4.7. And then look what happened. I mean, seriously, look what happened. This is not that much time went by, and we went from 4.7 to 3.6. We already talked about the spreads between mortgage rates and treasuries, right? What did we say it was? Spread between 10-year bond and mortgage rates. We said 1 to 2%. That was your cue, by the way, Todd, Debbie, or Dave, but that's okay. You missed it. Just be ready next time.
Thank you.
So if that spread is, let's just take the mid 1.5, which is very fair over the last 5 decades. So if we have a 10-year that comes down to 3.7, 3.65, we add 1.5% to that, we're at 5 1/8. Add 2% to your 3.6, and we're at 5.6. So it's not that far away to get where we're talking about. And each time we've gotten close, we've experienced these bounces. But you can see the last touch, and charts repeat themselves over and over and over. So if it breaks above this line, that could be problematic because then it's going to go up to where this line touched and got rejected. But for now, I really think we're going to sort of settle into this area and then slowly recapture what we've lost. Because we've lost 1% in the last, 10 weeks, something like that? I don't know. In fact, I want to go back and actually look at a day chart for you. I'll be more precise. But let's keep rifling through these. So this is kind of a timeline of things to look for in the near future, because you know that all of these things will impact the market in a potentially a big way. So we got the FOMC meeting coming on the 29th, unlikely to see rate cuts, but keep an eye on his commentary. That's the most important. And then we have inflation data being released for January and February. It'll give us a better idea if the Fed can cut rates. Inflation ticks up a little bit, the Fed is going to really freak out and not lower rates, maybe raise rates. We don't want to see inflation go up. And then we think in March we should see him cutting rates, but it depends on the data that he sees before the meeting, of course. The market is looking for only about 50 basis points in rate cuts. And if you're any kind of a contrarian, you would say, well, that's awesome. Because last year they were talking about 2%. And they usually don't get it right. And because everybody was looking at really big rate cuts, I went the other way. I was like, the mass is always wrong. You can always bet against the mass every time. So I think that, well, enough said about that one. So Dave also sent me this is one of those black swan events that could really hurt bonds. And so this is very hard to see, but this is showing you in 1965 how much the top 5 or 6 stocks comprised of the entire market. So back then it was about 28%, and it was these 5 stocks: AT&T, General Motors, Exxon, IBM, and Texaco. I find that fascinating because most of these you don't even hear about anymore. Um, and then now, and so the market's acting like, oh my God, this has never happened. This is terrible. It may be terrible, but it has happened, because currently we're closer to about 29% of these 5 stocks. And of course, there are Apple, Nvidia, Microsoft, Amazon, and Alphabet. So last time we saw this much concentration in 5 stocks, the market did this. It was just from 10,000 down to like 3,000, just in a matter of, what was that, a couple of years, a year, straight down. One of the longest bear markets in history. Well, what happens if we have a really long bear market again? Are consumers richer or poorer? They're poorer. Their net worth, people are spending right now because, they look at their 401ks, they look at all, their stock, and they just feel happy. But if you end up with a really long kind of secular bear market, they're not going to confident, they're not going to be happy, and that's going to drive rates way down. Talked about that. So what could change things? We kind of opened up with that. What could really help rates fall? Well, number one would be a significant drop in inflation. Number two would be a weakening job market. The Fed sees their primary duty is to create a labor market that supports everybody. And then, of course, we have black swan events, which we talked about, geopolitical events, or maybe too many fires in SoCal. But it comes from something that you do not expect, and we have gone way too long without one. The last black swan event was COVID. We are very, very due for another black swan event, but probably nothing will happen for 4 to 5 months, because they're going to want to see, Trump and what he does. By the way, that was one of the questions. So last time that Trump was elected, I think it started about December or January of 16. Rates just fell through the floor. I'm sure you remember that. It was an unbelievable bond market rally, paired up with an unbelievable stock market rally. So that was kind of the Trump effect. This time is more interesting because there are a lot of people that are not happy with where the economy is. It's a reason why, the right was elected this time. Consumers generally are not happy with the economy. So if he comes in and he's able to make that change, get things cooking, it's not going to help interest rates. For rates to drop, people would need to look at Trump and say, oh my gosh, he's going to kill the economy. This is the NAHB Housing Index. To me, this is one of the most important slides that you can show your borrower. This is essentially the affordability index. Higher is better. Housing affordability is around the worst it's ever been. This is kind of a 3-year look. So you have this housing, and normally, by the way, this number is way up here. It's just gotten whacked as rates have gone up. I should have gone back further, actually. But point being, this is a terrible number. And the fact that people are still buying homes, and I'm going to show you slides to show you that they are, with this kind of affordability, you drop rates 1% and this just shoots up straight up, and it kicks up the affordability. There's a level where affordability gets too low and it becomes dangerous historically. In 2007, we sold our house. It was before anything crashed, anything happened, but home affordability hit the lowest point it had ever hit. And then the subprime stuff started, there started to be some noise. So we bailed. And that was because of the affordability index. Saved us a lot of money. So here's the buyer's reality check. I think this is a really good slide. I'm not going to read it to you, but hopefully you can see what I'm talking about. The main point to here, and I don't know if it's made in the slide well enough, is if affordability is this low and people are still buying, what's going to happen when affordability becomes strong? I wouldn't want to be in a housing market at that point in terms of just multiple bids and all that stuff. So moving now is, I think, the smart money. So this is a recent survey. So, and these are put out all the time. Is it a good time to buy? 57% say yes. That's up from 54%. And is well up compared to 2023. That's a pretty good number considering affordability. This is where I was shocked. Is it a good time to sell? Only 27% of people think it's a good time to sell. I would have thought that would be half or more, that people would be worrying about interest rates, would be worrying about housing prices fall, but sellers are not worried about that. Price expectations, people are looking for pretty big numbers. Mortgage rate, this is a harder number to gauge because it was talking about the amount that it would drop. But what you can see is people are seeing the fact that rates will continue down. Job loss, that's a pretty big number, 54%. And then household income, people are looking for a little bit of a growth. I'm gonna pick up the pace now. So the NBA is looking for $2.3 trillion this year. That like 10 years ago, that would have been a number that would cause a refinance. 2.3 trillion is historically a very robust number up until the COVID thing. I remember back in 06, I think that was the best year ever, and that was like 4 trillion. And we're up from 1.8 trillion. So if you struggled this year, and I know a lot did, half of the struggling are gone. And now you're stepping into a more robust market. So this feels to me like a win-win. Fannie Mae's got purchase volume alone at almost 1.5 trillion. And then the lock-in effect continues to influence market dynamics. Many homeowners with lower mortgage rates are hesitant to buy or sell new homes at higher rates. We talked about this a lot, but this is going to shift. This is just a current look at 30-year mortgages, and it just kind of shows you that it really started getting ugly in 2022. This area was probably the most pain because every day was just another right hook, left jab, whatever. And now you can see it's kind of stabilized, and I would say 2 years of almost anything starts becoming the new norm, but the new norm never lasts long. So projected rates for 2026, this is using the model that I use. The average fixed rate mortgage is anticipated to range 5.3 to 5.9 with an average of 5.5. but that's saying 26. I believe this begins happening in 25. And then by 2027, I don't think these forecasts mean much. So there's some good stuff that would should concern you, and this good news just keeps hitting us in the face, and that's what's putting continued pressure on the bond market. But things like, look at the amount of companies planning on cutting jobs. That's way down from where it's been. The money supply is way up. The Fed did this on purpose. When the money supply was falling, then the stock market was under a little bit more pressure. Higher money supply generally can mean stronger economy, but the velocity of the money means more than the money supply. And velocity is kind of not a big deal. But this has gone up on purpose. And Powell wanted this to come up because he wanted a looser market. You know, disposable income, it looks really, really strong. It keeps going up. This is why Powell would say, I think my rate reductions are going to moderate. But when I show you this going further back, you realize it's not very impressive. We're seeing post-COVID numbers where things were terrible. Shorter term, people are saying that they're very optimistic. That number's growing. This is not helping rates. This is the perception of the consumer. But then you start kind of coming into retail sales and you realize they're anemic at best. Consumers have absolutely closed up their wallets. And that's going to continue to be a trend, I believe. This is the number of mortgage originations. And so you can see the number is beginning to tick up after really hitting bottom. And we're still close to where we were in 17, 18, 19. This is what I want you to lock in on. These volume, they're normal. We're pretty much at normal. So we just have to adjust ourselves in terms of number of LOs. Savings rate is absolutely terrible. This is a 5-year look. This is not going to help it. This is not going to help the economy. It's going to help interest rates. The United States debt. Oh my God, I can't even get into this, but this is actually creating a drag on the economy. I promise it is. And the analogy I give people is if you have $50,000 of credit card debt and you're having a hard time paying that, are you an optimistic consumer? Are you a buyer? No. So this starts becoming a problem. It is a drag on the economy. Building permits are extremely low. What do builders know that we do not? I found this crazy strange. We have no inventory. You would think the builders would be just building as fast as they can, but they're not. We talked about that one. GDP currently looks okay, but it's like, what, 3.5%? Not a bad number. It's about where it's been for many years. And many years, we had all-time low rates while GDP was up here. This tells you that GDP does not correlate with interest rates. It just doesn't. Consumer spending, it's horrible. I showed you a disposable income looked okay, but over a 5-year period, you can see this number is not very good. Inflation, as good as this looks, I have a better looking slide, but this is what the Fed wants. Bankruptcies. The things that make you say, wow, wow. Why isn't anybody talking about this? Why does the Fed somehow believe that he can moderate interest rate cuts when we have bankruptcies at multi-year highs?
Hey, Dan, in multiple interviews, it's come up that, seeing a definite increase in the amount of just borrowers in trouble. I mean, debt is at an all-time high. I mean, bankruptcy is kind of the worst case scenario, but to me, I have one of the top opportunities of 2025 is debt consolidation and helping people, restructure and reimagine their debt structure and their real estate plan. Like that should be something that everyone is leaning into aggressively. Any opinions on that?
100% agree with you. It's amazing. Like one of my children was over last night and we were just kind of talking and Her husband had a record year. He started a new business, and she's like, I don't know where it is. I don't know where it went. It actually makes me want to throw up that this much money comes in. And I said, well, let's talk about that. What's your biggest expense? Her answer was astounding. Credit card debt. I'm like, wait, you're sitting on $24,000 worth of credit card debt when your husband had the best year he ever had. That just doesn't really make sense, but I get it. I've been there where I have, a pretty good amount of cash and I have debt and I don't want to see the cash leave. I just want to keep that cash. And so what do? You keep this credit card debt and it just eats you alive. So people have got to get out from under that. And all of a sudden, 6% looks like a pretty low rate when it's getting you out of this really life struggling mess of this credit card debt.
Right. All right.
It's not going down, it's going up.
No, it's accelerating.
And default rates are going up.
Yeah,
So
and equity's accelerating still. So it's like a perfect environment for a mortgage professional to come in and optimize the equity and optimize the debt.
Agreed. This is the United States Leading Economic Index. It is exactly what it sounds like it is. It is a compilation of indices that create this United States Lending Index. I don't think this looks very good personally. So once again, what's the Fed doing? What does he believe everything is fine? Core inflation. Look at this. Went from a problem to the opposite of a problem. We're potentially going to be looking at deflation. If this number gets much lower, it starts to become a concern. Small business optimism. This first slide I did was like, wow, I cannot believe how good people are feeling. And then I ran the forecast. The forecast is it's not going to stay that way. People are not going to remain optimistic. So this model that's predicting much lower rates is also predicting things like this. Is that the same thing? Yeah, wait, kind of. Oh, this is showing this is core PCE. This is personal consumption expenditure. This is what the Fed uses more than CPI. This is the most important Fed number. And look where that's forecasted to go. I think I'm almost done. Stock market, again, this very same model is looking for a significant fall off in stocks. This starts playing into some kind of black swan. You see the stock market doing this, you see the job market projections doing this, you see optimism doing this, and then you see the stock market doing this. Of course, interest rates are going to do this. Personal spending. What's happening? Again, this model has been really good for me for a long time. And that's back to that slide. This corresponds with everything I just showed you, that the economy just gets a little bit worse, but it won't hurt housing. I've always said we're like the undertakers, the morticians of the economy. When this happens, it happens because, unemployment, all that, and we benefit.
So Dan is going to make these slides available. If you're watching this in YouTube, there'll be a link to a document that has these. We'll have a Google Doc that has all these slides. There's several of them that would be useful in social media. Deborah Bird, anything you want to call out? Any actions? Any questions? And then we'll bring it to Todd to wrap it up.
Well, I just so happened I was listening to the Altos Research market update, and they were going over their projections for where they think we're going to be just in real estate transactions. And I thought it was interesting in the topic of move-up buyers. He had said we're seeing more sellers come to the market, and that since it's been 3 years of essentially higher rates and 3 years of, the price, even though the rates have increased, it's not like prices have come down. It's been pretty resilient, that we're seeing more sellers come to the market, which is good news for buyers. And they really think that by the end of this year, we'll be closer to that 2019 normal era. Now, obviously that varies in different parts of the country, but I thought on a positive, we're starting this year with 26.8% more homes on the market that are unsold just from inventory numbers. So there's different messages to send out of just, hey, good news. There's more options and selections. We were down on immediate sales, so things aren't going under contract as quickly, which to me means a little bit less competition with multiple offers that you're going up against. But it does look like, if we have fewer loan officers in the business and, expected to do a few more transactions this year, then there's obviously more opportunity for all LOs who are still here hanging on to capture that business. So going after the move up, I think also the younger baby boomers who are wanting to downsize and get into more energy efficient homes. We're seeing, a rise in just that demographic. And then also the debt consolidation that's like my real estate story between my husband and I. The only way we were able to get out of credit card debt from being 2 teachers with 4 kids in 5.5 years, not anticipating those births and just daycare. If it wasn't for real estate, we wouldn't have been able to get out of that debt. So.
Yeah. And
it's true for a lot of people.
And guys, so Todd, before I give it to you to ask questions and help wrap this up, based on what Dan has said, I really see 2 big opportunity zones for sure. If Dan's right, we're going to see a rate and term refi opportunity zone. Now we're pretty far off of it right now. Optimal Blue has us aggregated at 5.9 today, and we really need to get here. But that's a real opportunity this year, and you should have a strike rate. But guys, here's for sure the big opportunity. You've got all these families that have rates in the 4s, in the 3s, in the 2s. Oops. And then we know that last year 24% of the sellers were first-time sellers. And I really believe from the data, there's a lot of first-time sellers, people that bought, that want to move up, they can move up, and they need a mortgage professional to help them see the light. And if you are delivering a fee worksheet, this is what you're delivering to consumers, and you're not showing them, hey, this is what it looks like to move from 4% to 6%, and look at the net worth increase by moving up. If you're not showing people how to buy before they sell, like different strategies to buy before they sell, you can't participate in that opportunity. And I just think it's a real big one.
Dave, that reminds me of your interview you did with Alec Hansen, where you talked about their top LO who were having those conversations. So to Todd's point about having more quality and curious conversations with our database so that what that strike rate is. I mean, if I remember correctly, he took 65 apps that ended up closing in that 2-week sweet spot. I can't remember the guy's name, but I mean, way to be proactive.
And by the way, when we do hit the next refi market, guys, have your scripting down and get people locked in. Take the refi, have it locked in. Too many loan officers had floating databases and really missed the window. Todd, takeaways, questions, win by noon notes.
It's always hard, and I never want to get on my soapbox, right? But that was someone who deserves to go to the Pro Bowl, right? The person whose database was so in line that they knew all the strike rates, and during that brief window, they captured all the refinances. And you know what? Unfortunately, it's not most of the people on this call. And I don't say that to be a jerk. I just say it to point out, there's the whole idea of, are you a pro or are you an amateur? And, we're here going into the playoffs and football. And I think that, my football analogy is pretty good. I mean, I feel like I've had some Pro Bowl seasons in my career. I think I've had some where, I made the starting squad of the NFL, and I had some where I made only the practice squad, and I had some where I was just not even anywhere. I was just sitting at home, driving Uber because I didn't make it onto an NFL team. And so the question is are you going to make the Pro Bowl in 2025 or not? And, or at least can you make the starting team, right? Can you, or maybe be a backup, but this is where you just have to unfortunately take a look in the mirror and decide who you are this year. Because ultimately, I think that the greatest of loan officers of history would tell you that they've had good years, average years, above average years, a little better years, and they've had these amazing years, these Pro Bowl years, but you have to be prepared for that. And so if you don't have a strike rate for every client in your database of when they want to refinance, then guess what? You're going to miss that window, whatever that window is. You might get lucky and catch a few, but the bottom line is this is your time to reach out to your database and have a strike date. Now, here's the scripting I've given my team. My team is not allowed to tell anyone that we think rates are going to go in the fives, right? And the reason why is because I think if we tell people that rates are going to go in the fives, guess what they're going to wait for? Rates to go in the fives. And you've got a lot of clients who would refi or buy if rates get to 6.5 or 6.25. And so what you don't want to use is what Dan just told you, which I think is the gospel. What you really want to use is what the MBA, Fannie Freddie, and Wells Fargo said, that rates are going to get into the low to mid sixes so that you have your clients ready and anticipatory for that. And so, certainly I'll give a quick commercial. Deborah and I, at the end of the month, the 30th and 31st, we're going to host the Pro Bowlers, or those who are trying to get there, or those who want to be on the starting team at the Exactly What to Say certification we're doing in Orange County. We did it in Orange County. Guess why? So we could get Dave to buy a ticket. So Dave will be there. We got Jake Bosco and his wife showing up. We've got Sean Herrera. We've got some great humans that you all know. And then I've got other great humans who I know who are a part of this community who will be there. And maybe that's something that you should step up and do. We're still honoring the early bird special. If you just go to toddbookspan.me, it's got a link to get there and it's got the early bird code on there, but would love to have you just ping me if you got questions on it. I'm happy to do that, or Deborah would be happy to do the same. But the bottom line is it's really easy right now to get into your database to have these conversations. I think you just have to do it. My team is doing something. Shayla Gifford's encouraging all of her folks in her Catalyst coaching. My team's jumping in. They're doing a thing called the Hammer 100 next week, where they're going to spend a whole day to have 100 actual conversations where they ask for a referral. So think about that. Like, that's Pro Bowl. That's going to set the team members who are successful and actually commit to that, right? They've got a week. They're doing it next Friday. They have a week to get their database together, their realtor list together. They can look at their phone, right? If you look at your contacts, I looked at my contacts. I've got almost 2,000 contacts in my phone that I can call and have a business conversation with. And I can unpack these pieces. Now, for my team, they've actually been through the Exactly What to Say certification. So we actually role play today on our call some of those conversations, and we're going to role play them on our team, jam session. But it's these ideas of how can you create these conversations and ask for those. But the bottom line is this: I'm pretty confident that people who dig in now in January of 2025 and work a little bit harder than they worked last year. I'm not saying a lot harder. I mean, don't get me wrong. That Hammer 100 is really hard, but I think you can set up your season and go forward. And what I encourage my team is you're going to create this list, and it's not just a one and done. This is your list that you are going to work really hard all year to be a pro in this business. The bottom line is I know that you're a pro because you made it this far, right? You're not one of the folks that's working part-time, that's doing these other things, or maybe you are, and then you need to get back in full time. But I think it's game time. I think it's go time. We've been waiting for this. And the problem is we're waiting for it to take action, and we actually have to take action before it happens. And so that's what I'm going to encourage y'all. That's my soapbox. I don't know, Dave, Deborah, what else you guys think on that?
Let's go, Coach.
Yeah, let's go.
Put me in the game.
There's a lot of opportunity, guys, but it's time to upgrade your skills and your actions. Hope to see some of you already. We have a great group. Also, Amir Saeed, and I think one of his top realtors are going to be at that workshop. He's flying in for that. Sean Herrera, who is actually going to be in town in just a little bit. So it's going to be a great room and a great event. Dan, anybody that wants to learn more from you, again, I think anybody that follows you in our group, you always put messages how to sign up, but what's the best way for people to reach out to you and connect with you and learn more and be part of your inner circle?
So my email is dan@universityofoptions.com, or you can go to universityofoptions.com. And just real quick, we teach people how to trade options, stock options, and then they live trade with us every morning. And we really don't have many losing mornings. And then we started a futures trading program and recruited, I think, one of the best traders in the world. I can't believe I got the guy. It's hard to negotiate with a guy that makes unlimited money, like literally. So, but we got him, and he runs our live futures room. And then we also developed some bots that trade futures very successfully. So if you want to learn more, we can show you, every morning. Well, I won't share my again. Every morning we we get testimonials from people that how they did in the morning, and they come in all day long. So it's been really fun to watch our members make money.
So follow Dan, make money. Todd and I are both customers of Dan, and my son went through the training and became a pretty successful day trader, and just can't say enough good things about what Dan does. So Dan, thank you so much, brother. Hope everybody got value from this. You got some perspective on interest rates. For those of you that made your guesses on what interest rates are, thank you guys for participating. It looks like I think 5.25 was the lowest from the audience, and most people were in the low sixes. So here's what I know. You can't control interest rates, but you can control the quality of your advice, the skills you develop in delivering advice, and you can control the amount of outbound activity that you make, whether that's a call, whether that's a text, whether that's an email. Reach out to the right people at the right time. Make sure you are using the Trust Engine app, or your company knows about the Trust Engine app, because it will tell you exactly who to call. And then it will also integrate with MortgageCoach, so that it will also create a MortgageCoach experience. So check out that, trustengine.com. All right, guys, this is a wrap. Take care,
Thanks
everybody.
for having me,
Have a
Dave.
great
See you
weekend.
guys. Bye,
See you.
everybody.
Whoever your favorite team is, go Broncos this weekend. Take care.